be recorded and posted on the IASBA website, so you can access it later and perhaps share it with your colleagues. In today's session, you will receive an overview of the revisions and restructuring changes in the International Code of Ethics for Professional Accountants. Before I introduce you to our presenters for today, I would like to invite Mr. Kong Yin Tong, President of the Institute of Singapore Chartered Accountants, as well as President of ASEAN Federation of Accountants, to give his opening remarks. Welcome, Mr. Kong.
Thank you for the introduction, Jeff. Warm greetings to everyone from all over the world. On behalf of the ASEAN Federation of Accountants, or IFAC, and the Institute of Singapore Chartered Accountants, ISCA, it is our pleasure to co-host this webinar with the International Ethics Standards Board for Accountants, or ISBA, at ISCA House. We are right in the heart of the Central Business District in Singapore, flanked by many professional services firms and financial institutions. Allow me to take this opportunity to briefly introduce IFAC and ISCA, both of which I helm as president, and the work that we do in ASEAN and this part of the world. IFAC is the organization representing the accountancy profession in ASEAN. IFAC can be likened to a lighthouse for ASEAN's accountancy profession, guiding its development and progress by working closely with stakeholders. IFAC seeks to uplift the professional standards of the accountancy profession in the region so as to support the booming economies in ASEAN countries. The member organizations of IFAC have more than 200,000 individual members. ISCA is the national accountancy body of Singapore and an active IFAC member. ISCA supports more than 32,000 members who work as professional accountants in practice and in business. ISCA is privileged to have collaborated with other ASEAN national bodies and stakeholders in Laos, Myanmar, and Vietnam on capability building programs. Since 2016, ISCA has organized 10 workshops in ASEAN for the private and public sectors, and this is still counting on. Today, we are discussing ethics, the cornerstone of the accountancy profession. Ethics is fundamental to accountancy. The business landscape is undergoing volatile and rapid changes, such as shifting demographics, disruptive technology, economic interconnectivity, and competition for talent, just to name a few. These forces, coupled with the race to increase bottom lines, create a challenging environment for professional accountants. As a result, accountants sometimes have the dilemma of upholding ethics and meeting the conflicting demands of their bosses. This predicament is real, having to decide between doing what is right and risk losing your job. I'm today joined by experts from ISBA, Ms. Caroline Lee, partner at KPMG and Asia Pacific Head of Quality and Risk Management, and Ms. Sylvie Soulier, partner at EY France in the Global Independence Group. They will share in detail the recently effective International Code of Ethics for Professional Accountants. Caroline and Sylvie will explain the code's new structure, as well as substantive revisions, including enhancements to the conceptual framework and provisions relating to inducements, including gifts and hospitality, pressure, and preparing and presenting information. Today's webinar will also touch on the new non-compliance with laws and regulations, NOCLA, and revised long association provisions, as well as ISBA's new e-code, which was launched in June 2019. Effective since mid-June 2019, the code reinforces professional accountants' responsibilities in complying with the 5 fundamental principles of ethics and emphasizes the international independent standards that apply in performing audits, reviews, and other assurance engagements. To all our avid listeners out there, I'm sure you will gain fruitful insights from this session. Once again, I would like to thank ISBA for choosing IFAC and ISCA as their preferred partners. We look forward to a more impactful collaborations with ISBA in the near future. Thank you.
Thank you, Mr. Kong. I would just like to give you a little bit more information about our presenters this morning, and then I will pass it along to them. Our first presenter is Ms. Sylvie Soulier. Ms. Soulier is an ISBA member and also our coordination liaison member with IWSB. She's also a partner at EY in the Global Independence Group, where she is responsible for overseeing independence policy, guidance, and implementation. She is also the independence partner for Asia Pacific, Japan, South, and Latin America. Our second presenter is Ms. Caroline Lee. Ms. Lee is also an IASBA member and a member of our fees task force. She is a partner at KPMG and the Asia Pacific Head of Quality and Risk Management. Ms. Lee is also a member of KPMG International's Global Quality and Risk Management Steering Group. So without further ado, I will pass it over to Ms. Soulier.
Thank you, Jeff. Greetings to all, and thank you for spending this time with us. It's very exciting to have a session dedicated to the Asia-Pacific region. Before we come with a number of details on our revised and restructured code, we thought we'd provide you some brief context why a very strong ethical code is more important now than ever. With our complex business environment, interconnected globally with new business models, advances and changes in technology, and also the increased regulatory oversight, there are much greater expectations for accountants to act ethically, and really a need for more guidance that we hope the code will provide. These expectations exist no matter what your role is as an accountant, whether you are a professional accountant in business, involved in government, not-for-profit, or commercial enterprises, or those who provide professional services to clients. Our mission at the IASBA is to serve the accounting profession and the public interest by setting ethical standards, including all related to auditor independence, and seek to raise the bar for ethical conduct, behavior, and practice for all professional accountants worldwide through a robust, globally observable code of ethics. We believe that having a single set of high-quality ethical standards can enhance the quality and the consistency of our services, and contributing to public trust and confidence in our accountancy profession. So our goal as a board in restructuring our code is really to revise it in a way that not only we will ensure it will serve the needs of our profession of today and of the profession of the future, but it will also be a very strong base going forward globally. We are hopeful that our new code will reinvigorate you to fulfill our mission as professional accountants and a trusted profession and serve the public interest. So let's look at our agenda for today's session. We will start with first with some background about the IASBA. Then we will have an overview, I would say summarizing what's in the revised and restructured code. We will walk you through the structure or the architecture of the code, and also focus on some of the key enhancements from the extant code. We will also provide you with guidance on some of the resources and the tools that are available to you to help you with the adoption and the implementation of the code, including showing you that exciting new project that we launched, the new e-code. And then at the end, we will close our approach by taking a quick look at the future and what is next to come on our work program for the coming years. Let's go next. Yep. So our first topic is really a few words about the IASBA and the standard setting process. I think it's very important to highlight that the composition of our board. It's a very diverse composition, diverse in background, diverse in geographies, and also with gender diversity. The board is chaired by a public member, Stavros Domadaki, And there are also 17 other board members from all around the world. No more than 9 of those members can be practitioners, and at least 3 must be public members. Our members are appointed by the IFAC board, but the nomination is also subject to the approval of the Public Interest Oversight Board, or the PIOB. So the PIOB is a body that oversees the ISB activities to make sure it serves the public interest. It is to really increase the public confidence that all our activities, including standard setting, are properly responsive to the public interest. We also receive advice from the CAG, the Consultative Advisory Group, which provides advice on our agenda, timetable, priorities, and technical issues. And both groups have a number of representatives to attend our ISB meetings. Our standard setting process also includes significant research and consultation to develop our standards. It is a very transparent standard setting process. It's transparent when we debate and discuss the issues at the meeting, because those meetings are open to the public. If you want to attend a meeting, you are very much welcome to register online and join us. All the agenda materials that we are using are posted online in advance of the meeting, and people can really follow along with the standard setting process. When we have a draft standard, there is always an exposure draft to be issued in order to allow for public comments, generally during a period of 90 or 120 days. We consider every response received as the next round of discussion and debate before finalizing the final standard. And we will really encourage you to participate in offering comments on those exposure drafts. For us, it's key for a standard setting process. As a key benefit of our rigorous standard setting process, we are very pleased to see the very widespread adoption of the ISB code around the world. The code is today used in more than 120 countries. Could be used directly, as sometimes directly translated or used as it is, or also it could be the basis for a local code of ethics. And it also has been adopted by the Forum of Firms for Transnational Audits. It's translated in 39 languages, and we even expect that the revised code will be translated in even more languages quite soon. For us, the widespread adoption is very important because the acceptance and the commitment to implement our standards would result in consistency of expectation, accountability for the professional accountants. Let's look very closely at our revised code. Okay. So the code, as it is, the revised and restrictor code, was released in April 2018, and it came into effect on June 15, 2019. The full title has been revised, renamed. You have it here in blue: International Code of Ethics for Professional Accountants, including international independent standards. It's the new title that really conveys the importance of having reference to the independence requirement. Why do we have that revised code? It's really that we wanted to respond to comments and feedback received on the need to enhance clarity and the usability of the code, and also to respond to certain difficulties in translating or understanding the complexity of the extant code. And we agree that if it is difficult to understand the code, it is necessarily difficult to adhere to it. We also had some questions and challenges from regulators and audit oversight bodies about the enforceability of some of the provision of the code. So from a practical perspective, we wanted to revise and restructure the code, and relying heavily on the feedback and the insight from a broad range of stakeholders to be really responsive. Beginning with some structural elements, the new design of the code is really intended to be much more user-friendly, so that our accountants will find relevant guidance, for example, if they are faced with an ethics-related issue, an independence issue, or dilemma. And we hope that that way it will easier promote positive and ethical behavior. Right up front, there is a guide to the code that really serves as a roadmap to help professionals understand how to navigate the code. The guide provides illustration how the code is structured and discusses how it should be used. It also highlights the importance of the fundamental principles and our conceptual framework and how those are working together as the foundation of the code as a whole. Another useful enhancement is the very clear distinction now that we have in the code between paragraphs that are requirements and those that are application material. Requirements paragraphs are marked now with an R, so there is no doubt that it is a requirement and they have to be followed. And the related application material is immediately located after every requirement and marked with the letter A. To us, it is also a response to facilitate enforceability. So what is really included from a content perspective in the code? It includes both some significant revisions and some repackage of some of all the advances in standards that had been released over the last 4 or so years. That, for us, definitely added to the complexity of the project, but we really wanted to have a fully repackaged code that would include all the standards in one code. So first, within the code, there were significant changes that were made to the conceptual framework, positioning it much more prominently, recognizing its importance, and also highlighting what we intend to be a safeguard, define it, and also have a much closer relationship and matching between a safeguard with the threat to the compliance with the fundamental principles. 2 recently issued standards, NOCLAR, non-compliance with laws and regulations, and also the long association standard were also repackaged to be aligned to the structure of the new code. And we will be spending some time later to discuss those 2 standards. And there were a number of new standards that were added. For instance, one on inducements offered or being offered to or by a professional accountant. And also new and revised requirements for a professional accountant in business in relation to the preparation or presentation of financial information. And also when, requirements to follow when facing pressure to breach the fundamental principles. Another revision is to have very clear guidance on the applicability of the code, whether it is for professional accountants in public practice or professional accountants in business. And finally, the new code provides clearer guidance on the importance of understanding facts and circumstances when exercising professional judgments, as well as new application material to explain how compliance with the fundamental principles supports the exercise of professional skepticism in audit engagements. So the next slide really provides a very quick look at the revised code architecture. So on this slide, you can see the distinct part of the code, beginning with part 1, which is an overarching part that applies to all professional accountants. It introduces the fundamental principles and the conceptual framework. Next, we have the requirement and guidance for the public accountant in business in part 2. And just as a reminder, in business would include the professionals accountant working in industry, government, not-for-profit, and so on. I mean, anyone, I would say, that is not a professional accountant in public practice. Part 3 and 4 are really aimed at professional accountants in public practice. General requirements for all practitioners are seated in part 3, related to conflict of interest, fees, inducement, no-color, and so on. And then there are the 2 specific independence requirements in part A, relating to audit and review engagement, and part B, relating with other assurance engagements. And then at the end of the code, you have the glossary that applies to the entire code. So really, this architecture follows a building block approach. Part 1 applies to all. Part 2 builds on part 1. Part 3, 4A, and 4B also build on part 1 to develop the public accountant in practice role. Our presentation today will also follow this approach. We will look first at the major enhancement for part 1, then look at part 2 and 3 together. Are they run in parallel? And then we will look more specifically at part 3A and 3B. So now I'm going to pass the presentation to Caroline, who will take us through some of the key elements of part 1 of the code.
Thanks, Sylvie, and good morning, everyone. Next, we'll cover the foundation of the code, looking at the fundamental principles and the conceptual framework applicable to all professional accountants. This slide reminds us of the 5 fundamental principles which have remained unchanged: professional competence and due care, integrity, objectivity, confidentiality, and professional behavior. These principles establish the standard of behavior that's expected of all professional accountants. They also reflect the profession's clear recognition of its public interest responsibility. Another thing that hasn't changed in the revised code is the overarching requirement for all professional accountants to apply the conceptual framework in order to comply with the fundamental principles. You may have noticed that independence is included on this slide. Independence is not a fundamental principle. However, the categories of threats to independence are the same as those applicable to the fundamental principles. That's the reason for its inclusion. The code now explicitly states that in the case of audits, reviews, and other assurance engagements, the application of the conceptual framework applies to compliance with independence in the same way that it applies to compliance with the fundamental principles. One of the big changes to the code is the prominence given to the conceptual framework, which is set out in section 120. Additionally, each part of the code is introduced with a discussion of applying the conceptual framework in the context of the professional accountant's role relevant to that particular part. The conceptual framework provides a robust, systemic, 3-step approach for professional accountants to use. The first step is to identify threats to compliance with the fundamental principles and to independence where applicable. The second step is to evaluate the significance of those threats identified. And the third step is to address the threats by eliminating them or reducing them to an acceptable level. In the slides that follow, we will discuss some of the important terms and concepts used in the conceptual framework. Terms such as threats, safeguards, acceptable level, and reasonable and informed third-party tests. Understanding these terms and concepts are important for the correct use of the conceptual framework. After the professional accountant has identified threats to compliance with the fundamental principles, The second step is to evaluate each threat to see if it is at an acceptable level. The code has revised the definition of an acceptable level. It now clarifies how a professional accountant would evaluate if the level of threat is acceptable by using the reasonable and informed third-party test. Whilst the extant code used the notion of a reasonable and informed third party, the new code now uses this concept much more explicitly by setting up a test that the professional accountant applies to the situation. The test requires the professional accountant to consider whether a reasonable and informed third party would be likely to reach the same conclusion as the professional accountant. This requires the professional accountant to look through the lens of a reasonable and informed third party. Who would be a reasonable and informed third party? The code clarifies that a reasonable and informed third party does not need to be a professional accountant. Rather, it is assumed to be someone who possesses relevant knowledge and experience to understand and evaluate the appropriateness of the professional accountant's conclusion in an impartial manner. So for each threat to compliance that the professional accountant identifies, they use the reasonable and informed third-party test to evaluate whether the threat is at an acceptable level, meaning would the reasonable and informed third party likely conclude that the professional accountant is in compliance with the fundamental principles. If the threat is at an acceptable level, then nothing else needs to be done. But if it isn't, then the third step of the conceptual framework will apply, and that is to address the threats using safeguards. The threats to compliance with the fundamental principles and to independence have remained unchanged in the revised and restructured code. They are self-interest threat, the threat that a financial or other interest will inappropriately influence the professional accountant's judgment or behavior. For example, a professional accountant in public practice holding shares in the audit client would create a self-interest to independence. The second threat is self-review threat, the threat that a professional accountant would not appropriately evaluate the results of a previous judgment made or an activity performed by the accountant or by another individual within the accountant's firm or employing organization, on which the accountant will rely when forming a judgment as part of performing the current activity. For example, a professional accountant in business determining the appropriate accounting treatment for a business combination after performing the feasibility study supporting the purchase decision. The third threat is advocacy threat, the threat that a professional accountant will promote a client's or employing organization's position to the point that the accountant's objectivity is compromised. For example, a professional accountant in business having the opportunity to manipulate information in a prospectus in order to obtain favorable financing. The fourth threat is familiarity threat, the threat that due to a long or close relationship with a client or employing organization, a professional accountant will be too sympathetic to their interests or too accepting of their work. For example, a professional accountant in public practice having a long association with an audit client. And the last threat is intimidation threat, the threat that a professional accountant will be deterred from acting objectively because of actual or perceived pressures, including attempts to exercise undue influence over the accountant. For example, professional accountants being threatened with dismissal from a client engagement or their employing organization because of a disagreement about a professional matter. The first step of the conceptual framework requires the professional accountant to identify threats to compliance with the fundamental principles and, where applicable, with independence. The second step is that the professional accountant has to evaluate and determine if the threat is not at an acceptable level. If the threat is not at an acceptable level, the third step is to consider if there are safeguards that can be applied. In the new code, the definition of safeguards has been revised to provide clarification on its meaning. Safeguards now refer to actions taken by the professional accountant to effectively reduce threats to compliance with the fundamental principles to an acceptable level. It is important to know that an appropriate safeguard may require more than one action to effectively reduce the threat to an acceptable level. Additionally, actions are required to correlate with the threat being identified. The code now includes and clarifies the concept of conditions, policies, and procedures. These may be useful in identifying threats and evaluating the level of threats, but will not be considered as safeguards. An example of how this works in practice is if a threat to familiarity with an audit client has been identified. A firm's rotation policy or legislative requirement will be considered in evaluating the threat, but will not be considered as a safeguard. The amendments now specifically clarify that identified threats that are not at an acceptable level must be addressed in one of three ways. First, eliminate the circumstance creating the threat, for example, by divesting of a financial interest that is causing the threat. Second, applying safeguards, for example, by reassigning duties, adding oversight, and so on. Or third, by declining or ending the specific professional activity or service. For example, by not accepting the job or not continuing the engagement. There's added emphasis on the last point here, that if threats cannot be addressed, the professional accountant must decline or end the specific professional activity giving rise to the threat. This acknowledges that some threats may not be eliminated by applying safeguards. The concept of safeguards have been clarified in the code, as previously mentioned, and safeguards are now much more closely aligned to the threats. The new code contains more specific guidance on the types of threats in particular contexts and provides potential safeguards that might be relevant and applicable. Finally, there's a new requirement to step back to review the overall conclusion about whether threats have been addressed as part of the professional accountant's responsibility. The professional accountant's understanding of facts and circumstances and the professional accountant's exercise of professional judgment are both critical to determining the appropriateness and effectiveness of the safeguard. The circle is continuous, as seen on this slide. As new facts and circumstances are identified, the professional accountant will be required to consider the conceptual framework in its three-step approach. New application material in respect of professional skepticism and professional judgment clarifies what was already implicit in the extant code. Professional accountants are better supported in fulfilling their duty to act in the public interest and, with the audit of financial statement, support audit quality. The revisions to the code require the professional accountant to exercise professional judgment when applying the conceptual framework. These amendments give more guidance in this regard and is applicable to all professional accountants. Although the concept of professional skepticism is more prominently dealt with in the auditing standards, it is also referred to in the extant code as part of the description of independence. The revisions elaborate on how the fundamental principles support the exercise of professional skepticism. An example of this is the accountant complies with the principle of integrity by being straightforward and honest when raising concerns about a position taken by a client and pursuing inquiries about inconsistent information and seeking further audit evidence to address concerns about statements that might be materially false or misleading in order to make informed decisions about the appropriate course of action in the circumstances. In doing so, the professional accountant demonstrates the critical assessment of audit evidence that contributes to the exercise of professional skepticism. This wraps up part 1 of the code, and we'll move on to parts 2 and 3 of the code. In this section, we'll look at part 2. Section 200 is an illustration of the building block approach. We'll see parts 2, 4A, and 4B, each starting with a reminder of the requirement to apply the conceptual framework and relevant application materials. The remainder of part 2, which is sections 210 to 270, present requirements and application material to specific situations that professional accountants in business commonly find themselves in. On this slide, sections that have been significantly advanced in the revised and restructured code are in bold. On this next slide, again, the top level section, section 300, outlines the requirements to apply the conceptual framework and also presents relevant application material. The remainder of part 3 in sections 310 to 360 present requirements and application material to address specific situations that professional accountants in public practice commonly find themselves. Again, on this slide, the sections that have been significantly advanced in the revised and restructured code are in bold. The code also recognizes that there are situations where a professional accountant in public practice might wear 2 different hats. Clearly, part 3 will apply to the activities when serving clients, but they might also be acting as a professional accountant in business in connection with activities they perform within the firm. For example, if a professional accountant in public practice is also preparing financial information for their firm, they should follow the ethical requirements in part 2 in connection with those activities. Given the fundamental role of professional accountants in business in the financial reporting supply chain, certain enhancements were made to section 220 of the code, which addresses the preparation and presentation of information. First, the code now provides more comprehensive provisions relating to the professional accountant in business responsibilities when preparing or presenting information. This includes not to mislead or influence inappropriately, including intentionally omitting information, and to use professional judgment when conducting one's work. Many times, a professional accountant in business needs to use discretion when making professional judgments. The code requires the professional accountant in business not to use this discretion to intentionally mislead or influence. Secondly, in an effort to support the professional accountant when confronted with the dilemma of what to do when in danger of being associated with misleading information, the code provides a number of suggested avenues, from raising the matter within the organization to consulting with a professional body, internal or external auditors, or legal counsel. Of course, while being mindful of any confidentiality requirements. If none of these avenues are successful, the professional accountant needs to disassociate himself or herself from that information, including potentially resigning from the employing organization. The code has newly enhanced provisions relating to pressure to breach the fundamental principles. The code states, despite that pressure, the professional accountant cannot breach the fundamental principles. In addition, the professional accountant shouldn't do something that will cause someone else to breach the fundamental principles. The code offers examples to bring to life the instances that might result in pressure to breach the fundamental principles. For example, there might be pressure to report misleading financial information to meet investor, analyst, or lender expectations, or maybe pressure to complete the job without sufficient skills or training, or within unreasonable timelines, or pressure to manipulate the entity's performance results in order to benefit others who will receive enhanced financial compensation. As with other enhancements to Part 2 of the Code, there is guidance for the professional accountant to consider what to do in these circumstances, perhaps through internal discussion or escalation, or disclosing the issue in accordance with the company's policies. Revisions to the Code relating to inducements affect both Part 2 and Part 3. Inducements is dealt with in Section 250 for professional accountants in business and Section 340 for those in public practice. These amendments clarify the appropriate boundaries for professional accountants with respect to both offering and accepting inducements. Inducements has been defined as objects, situations, or actions used to influence another individual's behavior, whether positively or negatively. More important is the new prohibition on offering or accepting inducements that have the intent to improperly influence behavior, even if the item is trivial or inconsequential. If there is no actual or perceived intent to improperly influence behavior, the professional accountant will be required to apply the conceptual framework. In addition to the new requirement to consider if the inducement has actual or perceived intent to improperly influence behavior, the Code also provides guidance on relevant considerations when exercising professional judgment on this matter. This includes considering what has been received, how often it has been received, when it has been received, why these items have been received, who is making the offering, and the transparency with which it has been offered. This consideration will help the PA, the professional accountant, determine whether there is an actual or perceived intent to improperly influence behavior. Another relatively recent and landmark addition to the Code is the standard on non-compliance with laws and regulations, or NOCLA. This standard was a result of over 6 years of extensive multi-stakeholder consultation. NOCLA sets out what is really a first-of-its-kind framework to guide professional accountants in what actions to take in the public interest when they become aware of a potential illegal act, whether it's committed by a client or an employee. This standard has been effective from July 2017 and includes a response framework. In certain circumstances, based on the professional accountant's role, this includes a clear pathway to disclosure to appropriate public authorities. This section considers 4 different roles of a professional accountant and offers proportionately different requirements and considerations. The 4 roles are a professional accountant who is an auditor, a professional accountant in public practice providing services other than audit, a senior level professional accountant in business, and finally, a professional accountant in business who is not in a senior role. The types of laws and regulations that this standard targets are those that have a direct effect on material amounts or disclosures in the financial statements, and those that may be fundamental to an entity's business and operations. Examples of these laws and regulations are set out on this slide. A professional accountant is expected to recognize non-compliance with laws and regulations within his or her knowledge based on his or her training and experience. Professional accountants are required to consider non-compliance with laws and regulations in relation to their client or their employing organization, or those charged with governance, management, or other individuals working for or under the direction of the client or the employing organization. Additionally, the response framework provides a measured approach, requiring the professional accountant in most instances to first obtain an understanding of the matter, followed by discussions with management and/or those charged with governance. Disclosure by the professional accountants to an appropriate authority as the first option would be applicable only in exceptional circumstances where there is reason to believe that the non-compliance with laws and regulations would constitute an imminent breach of a law or regulation that would cause substantial harm to investors, creditors, employees, or the general public, and discussion with management would therefore not be appropriate. There are many resources available on the IFAC website on NOCLA. Of special mention are the NOCLA fact sheets and Q&A. Comprehensive Q&As with a separate Q&A for professional accountants in public practice and another for professional accountants in business, taking into account the consideration of their respective responsibilities, are available. Let's now look specifically at 2 of the roles, that is the senior professional accountant in business and the auditor. After the senior accountant in business has identified a non-compliance with laws and regulations and obtained an understanding of that non-compliance, he or she will be required to discuss this matter with management or those charged with governance. This will include advising management, if they've not already done so, to rectify the non-compliance, to mitigate consequences of the non-compliance, to deter the non-compliance from recurring, and for management to report the non-compliance to the appropriate authority. Additionally, the senior professional accountant in business will need to consider if disclosure to the external auditor is required. It is important for the senior professional accountant in business to consider their responsibilities and other professional accountants within the entity before a NOCLA has been identified. This will allow them to discuss the entity's policies and procedures to prevent and deal with non-compliance with laws and regulations. They should also take into account the reporting line. So if a non-compliance with law and regulation is identified, a reporting structure will already be in place. In the case of the auditor, Non-compliance with laws and regulations provisions do not override the requirements of laws and regulations that are present in the country. The auditor will still need to comply with their regulatory obligations. This may include requirements to report the non-compliance with laws and regulations to appropriate authority and or prohibiting them from informing the client or tipping off. Similar to the senior professional accountant in business, after the auditor has obtained an understanding of the non-compliance, he or she is required to discuss this matter with management or those charged with governance. This includes advising management to rectify the non-compliance, to deter further non-compliance from recurring, and for management to report the non-compliance to the appropriate authority. Depending on these discussions and actions of management and those charged with governance, the auditor will be required to consider if a report to the appropriate authority is the right course of action for the auditor. Additionally, the auditor will need to consider his or her continued association with the audit client as an auditor. I will now hand it back to Sylvie for the next section.
Thank you, Caroline. Let's have a look now at the specific independence standard on Part 4A for audit and review engagement and 4B for assurance engagement other than audit and review engagement. So in this section, we walk through the enhancements to those for Part 4A and Part 4B. So Part 4A, relating to audit and review engagement. As we did earlier with the Part 2 and 3, here's the list of the sections that fall within the scope of Part 4A. And once again, the sections that have been significantly advanced in the revised and restructured code are bolded. Section 400 is a reminder of the requirement to apply the conceptual framework and the applicable application. And the reminder of Part 4A are materials specific to certain situations where independence is required. If I move to Part 4B, this really mirrors the structure of 4A. So same information dealing with the independent standard for assurance engagement other than audit and reviews. That could, for instance, include reports such as assurance on a company's system of internal controls, or perhaps assurance on a company's statement on its greenhouse emissions. So now let's have a quick look at some of the very key strengths and provision around long association between auditors and their client. This project on long association does have a long history with the ASBA. There were 2 exposure drafts that were issued on the topic, and in addition to a significant amount of discussion, largely around the requirement for cooling off period. It really coincides with the fact that during that time, other jurisdictions around the globe had implemented more restrictive cooling off period that were in the code. And there were a number of calls for the ISBA to revisit our partner rotation provisions. These provisions are particularly important to address the familiarity and self-interest threats to independence that arise from serving an audit client for a long period of time. In the past, I would say the prior version of the code, anyone who was a key audit partner on a public interest entity had to cool off from an engagement for 2 years after having served as assurance partner or audit partner for 7 years. As a result, if you look at the combined effect, an engagement partner could have served for 14 years out of 16 years on the same client. And this was a reason why we were told that the code was perhaps not fully responsive to the need to address the issue. So today, in the code, the time-on period is still 7 years, but the cooling-off period have been adjusted and lengthened depending on the role of the partner. It is now 5 years for the engagement partner, 3 years for the engagement quality control review partner, and any other partner on the engagement who qualifies as key audit partner would still have a 2-year cooling-off period. It is also important to highlight that there are more restrictions about the activities that are permissible during the cooling-off period. For instance, during the cooling-off period, there cannot be any technical consultation with respect to the audit or assurance engagement. Second, there is also a prohibition on acting as the client relationship partner during the cooling-off period, and that is really also to continue to address the familiarity threat. And finally, there is an overarching requirement that any other activity that aren't expressly prohibited should not involve frequent interaction with senior management or those charged with governance or result in any direct influence over the outcome of the audit engagement. Whether a client is public interest or private entity, there are also some additional revisions. Because the long association threat does not happen only for our partners doing audits. So for private entity, also there are no specific cooling off periods stipulated. There is a requirement that the professional accountant will consider the threats from serving a client for a long period of time. And this is regardless of the role the professional accountant has with the audit client. We are also aware that the new provisions that have been introduced, in particularly by introducing different lengths of cooling off period, has created some additional complexities. For instance, when you have a partner moving from a quality control role to become the engagement partner. So the code does go in some specific analysis, application material, and look at the complexity of various situations to provide some guidance. And it is also supplemented by additional materials such as FAQs. While this section came into effect in December 2018, there were also some restructuring changes as the result of the restructured code. So it created more substantial changes to the examples of the safeguards that are applicable. So I would really recommend you also to look at those FAQs which are addressing the scenarios and those complexity in the ISBA website. Now let's take a closer look at some changes that were made to the section 600 and 950 on the provision of non-assurance services. Section 600 and 950 have been significantly enhanced in the restrictor code. They were reviewed, and those reviews are really the foundation of how the conceptual framework applies to independence and non-assurance services in particular. They clarify how firms should apply the conceptual framework, including how to identify threats from providing non-assurance services, and how to evaluate the level of those threats and address those threats when providing those services. There were some added refinements created to include additional examples of factors to consider to facilitate the evaluation of the level of the threats. And there is also some new application material within each subsection addressing the diverse categories of non-assurance services with examples of actions or appropriate safeguards that might address the threat to independence. So now when applying the conceptual framework in this area, the code clarifies that the threat created from providing multiple non-assurance services to an audit client are also to be identified, evaluated in the aggregate, and addressed as well. So in other words, you need to think about the totality of the combined service and not just a single service in isolation. The code also increases the prominence of requirements that prohibits from assuming a management responsibility when providing a non-assurance service. There are a number of new examples that are introduced that describe what would be considered a management responsibility. And finally, the code is very clear that by saying that there are certain non-assurance services that are creating threats that cannot be addressed by safeguards or any action, and therefore that would lead to a prohibition. For any non-assurance service that is not expressly prohibited, but when it is determined that there is no applicable safeguard to reduce threat to an acceptable level, the code is very clear that either the non-assurance service or the audit engagement must be terminated. As an example of how the application of the revised conceptual framework led to stricter provision, let's have a look at one specific services where we modify the code as well. And that relates to the provision of a particular type of non-assurance service, the provision of recruiting services. In the past, in the prior version of the code, those services were prohibited when provided to a public interest entities. And in particular, that was relating to searching or seeking out candidates on behalf of the audit client, and to take some reference checks for a director or an officer of the client, or for senior management in a position to exert significant influence over the preparation of the client's accounting records or the financial statements. Actually, when we were looking at those services and trying to find what would be the some relevant safeguard, the ISBA could not identify any appropriate safeguard for those recruiting activities. And therefore, we determined that it should be prohibited whether provided for a public interest entity or a non-public interest entity. So with the updated code, the prohibition now extends to all audit clients, PIs and non-PIs. So this is really a type of service, in particular, where there have been some significant enhancements. Because we wanted also to provide